In 1986, Congress buried a single tax provision inside a 900-page reform bill, and the largest corporations in America had restructured around it before most small business owners learned it existed. No press conference, no guidance. The IRS watched it happen. By the end of this, you'll understand exactly why they didn't tell you. Most people know two ways to handle risk. You either pay an insurance company to cover you, or you absorb the loss yourself. That's the choice they teach you. That's the choice they want you to believe exists. For most of the 20th century, that was the whole conversation. A business owner paid premiums to an outside carrier. The carrier kept the profit if nothing went wrong. The cycle repeated. Nothing questioned. Nothing examined. What wasn't taught, what almost no financial advisor would mention unless pressed, is that there is a third option. And for 40 years, the wealthiest businesses in America have been using it quietly. It's called a captive insurance company, and the mechanics are almost insultingly simple once you see them. Instead of paying premiums to an outside carrier, a business creates its own insurance company, a separate legal entity. It pays premiums into that entity, premiums that are tax-deductible. The captive holds the money. If a loss never happens, the money stays inside the structure. It grows. The owner controls it. Congress made this legal through Section 831B of the tax code. One section, 4 digits. Corporations with in-house tax departments found it within months. They built captives. They kept their premium dollars. They paid far less to outside carriers. The provision was open to any qualifying business, not just corporations. A dentist, a construction company, a small manufacturer. The income threshold was modest. The filing requirements existed but weren't extraordinary. The tool was there. The law was clear. Almost no small business owner was ever told. The official explanation, when you eventually get one, goes like this: captive insurance is complex. It requires actuarial studies, regulatory filings, proper risk distribution. It isn't for everyone. That part is technically true. Captives do require structure, but here's where the explanation collapses. The Fortune 500 has been running captives since the 1970s, before 831B even existed. General Motors, Ford, Disney, Procter & Gamble, every major carrier of self-insured risk had in-house entities managing exactly this. The complexity argument applies equally to them. They hired the people to handle it. The difference wasn't complexity. The difference was access to the information in the first place. And access, it turns out, followed a very predictable pattern. It went to whoever could already afford a law firm on retainer. Now here's what makes this harder to dismiss as coincidence. In 2013, the IRS placed certain captive insurance arrangements on its list of transactions of interest, one step below officially designated abusive tax shelters. They began auditing captive users. They challenged arrangements. They pushed back on small business owners who had set up captives through third-party promoters. The message was unmistakable. The IRS was now watching, but watch what didn't happen. The Fortune 500 captives kept operating. Captive insurance remains a fully legal and recognized risk management tool. The IRS itself confirmed that in its own guidance, legitimate captives, properly structured, remain valid. What the scrutiny actually did was change the cost-benefit calculation for small business owners. Now you needed not just an actuary, but an attorney ready to defend an audit. The price of entry went up, not through legislation, not through a formal rule change, but through enforcement posture. Through the implicit threat of examination. Between 2013 and 2023, small business captive arrangements declined. The corporate captive market, held by large carriers and Fortune 500 subsidiaries, barely moved. The tool didn't disappear. The access point narrowed, and the narrowing fell exactly along the line between those who had legal counsel and those who didn't. Think about who benefits from that arrangement staying quiet. Commercial insurance carriers collect roughly $900 billion in premiums annually in the United States. That figure depends on businesses not knowing there is another option. It depends on owners continuing to pay external premiums on risks that never materialize, risks that, inside a properly structured captive, would have stayed in their own pocket. The financial advisory industry largely didn't flag this either. Captive insurance sits at the intersection of tax law, insurance regulation, and corporate structure. Most CPAs don't specialize there. Most insurance brokers have no incentive to point you toward a vehicle that eliminates their commission entirely. The silence wasn't manufactured by a single decision in a single room. It was the natural result of a system where the people who profit from your not knowing are the same people you call for advice. That's a harder kind of buried. Because there's no document to unclassify. Section 831B is still in the code. The option still exists. The question isn't whether it was kept quiet. The question is why, in 40 years, nobody thought to make sure the people it was supposedly written for actually found out about it. Or maybe someone did think about it and decided not to.